Today, the economic situation of companies has not been this bad since the crisis of the 1930s. And this is all due to the crisis of the anti-COVID measures. Unemployment is at record levels, with 800,000 new job seekers every week in the USA. As a reminder, 800,000 new job seekers a week was the paroxysmal and very specific level of the 2008 crisis. Today, this is the level of stabilization. Pay attention to the change of scale between the two graphs. Small and medium-sized businesses are kept afloat with subsidized loans from the government, and the purchasing power of their clients is also maintained through massive injections of money directly into the pockets of individuals. And yet, the markets are rising. The reason for this increase is well known. As long as the central banks inject money, then the savings will go into the equity and real estate markets, because these are investments in tangible assets. Today, I would like to give you the vision of George Gammon, who is an American with a YouTube channel who does very good analyses. If you speak English, go and see, if you don't already know him. The conclusion of his analysis is simple. The markets will eventually crack definitively upwards under the weight of inflation in financial assets. I invite you to understand why, and especially to see how to get out of it by rethinking your financial portfolio in order to take full advantage of our ability to invest in money anywhere on the planet. Come on, let's go. Gammon's idea is simple to explain. Since the internet bubble, central banks have gradually monetized crises through monetary printing. This is called the Fed put, for impetus of the Fed. Europe was entitled to its ECB put in the same way, since for over 20 years, the balance sheets of the Fed and the ECB started from about the same level to reach records of equivalent balance sheet sizes. That's why we talk about monetary injections compared to the self-destructive behavior of a drug addict who hurts himself to gain a little time before being confronted with reality. But that's not all. George Gammon pointed out an important fact during the crisis of March 2020 that I remember very well, because it prevented me from sleeping for several days at the time. On March 3, 2020, while the American markets fell 12% in 1 week, the Fed lowered its rates by 0.5%, which is a lot, considering they were only at 1.75% at the time. And there you see that this is not enough. Markets continue to collapse. They lose another 10% in 1 week between March 5th and March 13th. At that time, during the week of March 15th, the Fed announced that it would put its interest rates at 0%. Then, on March 15th, very precisely, the Fed brutally lowered its key interest rate to 0%. But the markets continue to fall. This second drop in interest rates does not stop the fall in prices. It will take the announcement of the CARES Act, which is the first program of financial support directly to the population, for the markets to recover. For the first time in 20 years, it was not the injection of the central banks that caused the markets to restart, but the famous money helicopters. As a reminder, what is called a money helicopter is a policy of distributing money to the population resulting from the monetary printing by the central banks. However, this is indeed what is happening, since central banks, whether in the US or in Europe, will buy the vast majority of government bonds issued by the US government to finance these programs of direct support for the economy. This is why we can say that the illusionary independence between central banks and the government has been shattered since March 2020. There is today a merger, in fact, between the central banks and the supervisory governments. That's why in March 2020, I slept very badly. The whole question at the time was whether these cash injection programs would be enough to keep the markets from crashing and the economy from sinking. This is what George Gammon's video tells us. What is called the impulse of the central banks, the Fed put or the ECB put, has been replaced by the impulse of the government. And this is why I remain very cautious on the markets. Whatever the end of this story, this cannot go well, since we are floating in this crisis thanks to money that is printed without consideration. So, what does George tell us at this point? His point of view is simple. Since the combined governments and central banks have decided to inflate the economy and markets with fake money, markets and tangible goods will crash higher once the government's monetary injections become just as ineffective as the central bank injections. This is the meaning of George Gammon's drawing on his famous whiteboard. The governments continue to inject to support the markets. At one point, the markets no longer believe in it and crash. And it is at this point that the governments print more and transform the dollar or the euro into monkey money. From then on, the stock markets explode because it is better to have stocks that follow inflation than cash that is worthless in a few months. That's what happened in Argentina when the Argentine peso broke. Hang on, the Argentinian markets have experienced a parabolic rise between 2013 and today. They have increased 25,000 times. Of course, the exchange rate of the Argentine peso has gone the other way. And this is where we need to talk about the dollar. If you look at the US stock market, the SP 500, then it's up 12% from its pre-crisis high. The Americans are therefore very happy and the mood is celebratory on the markets. But then again, if you bring the SP 500, which is quoted in dollars, to a basket of international currency, then it's not the same thing. Louis Vincent Gauve produced this graph for GovCal research by bringing the SP 500 back to the DXY evolution. In this case, it can be seen that both the US and global markets have caught up to pre-crisis levels, but no more. You're going to tell me that it's already not so bad. But don't forget, the DXY is more than 50% euros, so a basket of currency pretty close to the dollar. If you do the calculation against the yuan, the Chinese currency, then the balance is much worse. Against the yuan, the dollar has lost 9% since March 25, 2020. The SP 500, expressed in yuan, is therefore 10% lower compared to its pre-crisis level. Again, you're going to tell me that that's not so bad, since we went to minus 40% at the worst of the crash. And yes, but we must not forget that the yuan is structurally undervalued against the dollar and the euro in a tacit agreement between the USA, Europe, and China, because the Chinese are ready to sell cheaper to Westerners to finalize the construction of their domestic demand. The day China decides to structurally raise Asian currencies against the euro and the dollar, it is not impossible that the yuan will be up to twice as high as it is today. In that case, the New York Stock Exchange will begin to look like the Caracas Stock Exchange in Argentina. The main idea is to balance the portfolio between tangible assets that follow this currency depreciation. Cash in currencies that do not monetize too much see not at all the crisis of the anti-COVID measures. Bonds in China, of course, since China did not print during this crisis and it remunerates its bonds at more than 3%. And finally, in stocks in key sectors such as Japan and Asia, but also high-tech without going through the excess of the Nasdaq. And on that note, I'll see you soon for new videos. Ciao!
Thank you so much for watching. If you like my videos, please subscribe and don't forget to hit the bell if you want to be notified of the next episode. And if you want to invest in the stock market over the long term or diversify your financial portfolio, I'm offering you an analysis of the 8 European star stocks to have. Thanks again for watching and have a great day.